Welcome to Arnerich Massena's first quarter 2016 Market Insight. Hi, I'm Arthur Coyne, Senior Research Analyst. Stocks got off to a rough start in January as the Chinese currency, the yuan, devalued to a 5-year low and oil prices fell to a 13-year low. But by mid-February, stocks, oil, and the yuan began to recover, and by the end of the first quarter, they had all returned to roughly where they started. Overall, worldwide growth was slow and inflation was subdued. This fostered lower interest rates and higher bond prices. Coupled with a 4% decline in the value of the US dollar, global bonds delivered their best quarterly performance since 2009. During this difficult period, central banks stepped up their measures to spur growth and fight deflation. In January, to stimulate lending, the Bank of Japan began charging banks 0.1% interest, a negative interest rate, on idle excess reserves held at the Bank of Japan. In March, the European Central Bank cut rates further and expanded its bond purchasing program to include non-bank corporate debt. And throughout the quarter, citing global concerns, the U.S. Federal Reserve took a more dovish tone, leading investors to scale back their expectations of future rate hikes. Here at home, economic growth has been moderate versus a year ago, but appears to have been slowing in recent quarters. Demand and employment in services are continuing to grow, but manufacturing and exports have lately been in decline. This is partly attributed to the strong US dollar, which, despite its recent downtick, remains 16% higher than 2 years ago. It's not surprising then to see that corporate earnings growth has stalled, as we can see from the blue bars. So while stock returns have outpaced earnings between 2012 and 2014, we're now seeing stock returns coming more in line with the earnings trend. In the bond market, we're seeing corporate yield spreads to treasuries widening, offering higher potential return for higher perceived risk. For example, at quarter end, high-yield bonds, those rated below BBB, were offering yields in the 8% range, or about 6 to 7% above treasuries, which were yielding between 1 and 2%. These higher yield spreads were largely driven by the risks that low energy and commodity prices have been posing to the credit quality of debt issued by producers and related industries. Looking at fixed income returns, we begin by noting that worldwide bond yields have sunk to record lows. This creates a situation where bonds often produce returns that are driven more by market fluctuations than by interest income. This is precisely what we saw in the first quarter, as declining interest rates and a down leg in the US dollar were the primary drivers of bond returns. Among stocks, emerging markets came back from their slump to lead the way in the first quarter. This was fueled by low initial valuations, currency appreciation, and a late quarter rally in commodity prices. However, we note that over longer periods, such as 5 or 10 years, U.S. stocks have outperformed their international counterparts by an unusually wide margin. This is due to a combination of factors, including the faster U.S. recovery from the financial crisis, declining commodity prices, and a willingness among investors to pay a premium for U.S. companies. Looking to the future, continued long-term U.S. outperformance of this magnitude seems highly unlikely. For example, if the past 10-year performance gap between U.S. and international returns were to continue for another 20 years, all other things being equal, the U.S. stock market would grow in size to consume 75% of the world's equity investment capital, an unlikely prospect for a country that has only 5% of the world's population and under 25% of the world's GDP. Our first quarter positioning remains unchanged from the prior quarter. In stability, we are overweight low volatility hedge relative to global fixed income because we are focused on credit strategies that manage interest rate risk. And in growth, we are overweight equities relative to hedged investments due to our conviction in thematic and impact investing. For investors who are able to use private markets, we favor private markets over the public stock markets. We continue to pursue return premium and yield opportunities across the entire range of asset classes through active management and innovative investment strategies. Your advisor will keep you informed regarding these opportunities as they become available. Thank you for joining us this quarter. This concludes the Arnerich Massena First Quarter Market Insight.